Okay, everybody. This is Tim Travis, CEO and Chief Investment Officer of TNT Capital Management. Thanks so much for joining us today. We're going to talk about cash secured puts and how you can utilize them to improve the returns in your portfolio, reduce risk, enhance the income, and really to manufacture a disciplined entry price into stocks. So it's probably our favorite strategy beyond just the basic value investing framework. So let's go ahead, let's go get started. So firstly, investing in the financial markets involves risk of loss. Options are not suitable for all investors. Past performance is not indicative of future results, and this presentation is for educational purposes only. Okay, so it's May 18th, and Ally Financial closed. It was up about 4% today at 27.28. Now, the banks have been really the center of the storm this year since March. So they actually got off to a great start early in 2023. Business conditions were pretty good, and then the sudden collapse of Signature Bank and SVB Financial really disrupted the market quite substantially, and caused a massive sell-off in the banks, similar to what we saw in 2020 and even 2009, or excuse me, 2008 for the regional banks. So Ally was kind of caught up in that storm, despite having a very different framework. They originate much higher yield loans than like an SVB, for instance. They pay pretty hefty deposit rates, which could be seen as a positive or a negative. I mean, on the positive side, you know, the depositors are getting very competitive yields, so there's not really as much of a rush to shift it over to someone else. On the negative side, they don't have all of the non-interest bearing deposits of like a Bank of America or a Wells Fargo per se. But Ally has been, a lot of their loans, commercial loans, and they loan money to car dealerships, and all of those are adjustable rate loans, and so they've been adjusting higher with higher rates, and then they've been increasing their pricing on the retail side, retail auto loans, to where they're double-digit yields now. So they're doing a good job kind of offsetting the higher funding costs. So when you look at Ally as of the most recent quarter, so after Q1, the adjusted tangible book value per share was $31.59. If you add back the accumulated other comprehensive income losses, so like some of the other banks, Ally invested into mortgages and stuff like that as part of their banking operations, and mortgage loans originated when rates were 2.5% or 3%. They're underwater, so they've lost value. So they have about $13 in losses in AOCI. So if you add that back, so those are money good loans, for the most part, like let's say 99%. As those get added back, that would increase the tangible book value per share to about $44.14. So the current price to tangible book is about 86%. Tier 1 capital well above minimums at 9.2%. We think that the normalized earnings power is about $5.74 a share. They've made well more than that a few of their peak years, but that's a very conservative estimate using kind of their normalized book value metrics. And so the normalized earnings yield would be 21%. I mean, that's incredible. If you could buy a business the quality of Ally's at a normalized earnings yield of 21%, it's tough to not accept that opportunity, in my opinion. Over the last 12 months, they've earned about 409. The trailing 12-month earnings yield's 15%. So even at kind of lower earnings levels, it's still a very good return, and the dividend yield's 4.4%. So even this year, I mean, even if they only earn like $3.50 per share in a trough year, and that would be kind of almost a recessionary scenario, higher funding costs, banking stress type thing. You're still just paying a very, very cheap price for Ally. So we think the stock is conservatively worth between $40 to $50 per share. Say 40 to 45 there, just to be very conservative. And so we think the stock and the business should be able to grow tangible book value by about 10% per annum, adjusted for dividends. Okay, so owning the stock certainly makes sense, but let's say, you're more conservative and you like Ally, but you're concerned that maybe there's a little more downside. You'd like to own it at a little lower price. How do you do that? So what you can do is you can sell puts. So we're going to sell the January 2024 $23 put, and we're going to collect $220 per contract. Every option is equivalent to 100 shares of the stock. And so I know that options can seem complicated to a lot of people, and the way a lot of people do use options is complicated. At TTCM, we're quite simplistic. We're going to make it a heads or tails type scenario. There's really only two things that can happen, assuming you hold the option till expiration. So heads, if Ally is above $23 at expiration, you'll earn the whole target profit of $220, which is 10.57% on the maximum risk, or 15.78% annualized in 246 days. So very healthy return, healthily in the double digits, and your risk profile is a lot lower, as we're going to discuss here. Now, if Ally expires below 23 at expiration, you're going to end up owning the stock at a break even of $20.80 per share. So that's the $23 strike price minus the $2.20 per share premium that we collected. So that makes your break even. So that break even of $20.80 provides us a staggering 23.7% cushion from the current market price before we would begin to incur losses upon option expiration. And so then if exercised, we would have all the upside or downside from there. So if you like Ally, as we do, we've invested in the stock for a long time, bought and sold at various prices, and have been very successful with it. I feel like the business is really poised to capitalize on this disruption. They're picking up deposits. They're still growing in that area, which a lot of banks aren't. A lot of banks are kind of getting out of auto loans, in the current stress environment. And so that's opening the door for Ally really to say, okay, we're only going to take loans that really meet our risk-adjusted return framework and parameters. And so they're able to be very picky, but still get that higher yield. As I mentioned before, a lot of their commercial loan exposure is adjustable rates. So they're in a great spot. And yes, they'll earn less this year than in some of their peak years. But within 2 to 3 years, I would expect them to be, approaching their all-time highs again as far as earnings per share and probably share price as well. So I think it's a great fit there. So that concludes the presentation. This is our firm. You can reach us at tim@ttcapitalonline.com, and our website is ttvalueinvesting.com. And my direct line is 805-886-8140. Thanks so much. Hope you have a great day.